With a 5% yield on cash, why would anyone want to invest in stocks and bonds? I know that cash feels good because its nominal value is stable, it feels safe, but it's counterintuitively extremely risky for long-term investors. Cash is a poor hedge against falling expected returns. It is historically much more likely to lose purchasing power than stocks and bonds in the long run, and real returns on stocks and bonds have historically been higher at higher levels of real interest rates, making cash a relatively poor long-term investment even when interest rates are high. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to tell you why cash is a terrible long-term investment. I want to be clear to start that this video is about money that you can direct toward long-term investments. Keeping cash set aside in an emergency fund is often a good idea, and that cash should not be kept in anything volatile since it's set aside to cover short-term needs. High-interest savings accounts, currently available to retail investors through high-interest savings account ETFs, are paying more than 5% in annual interest at this moment. When you can get a 5% yield on your cash, stocks and bonds might seem to lose some of their luster as long-term investments. It is well documented that investors' exposure to risky assets is sensitive to interest rates. When interest rates are lower, investors reach for yield in riskier assets, and when interest rates are higher, they reduce their exposure. Cash is safe day to day. When markets are volatile, cash, especially in a country like Canada, is going to be there when you need it, while stocks and bonds change in value often materially every day. Investors are always worried about the next market crash, probably more worried than they should be, and this results in reduced exposure to risky assets like stocks. Risky assets sound risky, and they are, but risk is not always a bad thing in investing. Most investors think about cash or short-term government bills as the risk-free asset in managing their portfolios, but this is only applicable to a short-term investor. The first thing to understand about cash returns is that while the value of cash is stable, the expected return on cash is unpredictable. The current 5% yield on cash is definitely attractive, but the relationship between the current short-term return on cash and the long-term return on cash is, at best, very noisy. Based on regression analysis of historical data, we attribute only a small portion of the expected return on cash to its current yield when we run financial planning projections at PWL Capital. A 5% cash yield today does not mean a 5% cash yield tomorrow, and this is a problem for long-term investors. Short-term volatility matters a lot to short-term investors. If you wake up tomorrow and you have 20% less money in the bank account that you are going to use to buy lunch, you will not be happy. On the other hand, if you wake up and your cash is earning 3% interest instead of 5%, you can still afford your lunch. Long-term investors care less about volatility and more about how their expected returns change with volatility. For example, a drop in the value of a long-term portfolio that is offset by an increase in the portfolio's expected return is actually irrelevant to a long-term investor. Based on this, the risk-free asset for a long-term investor is not cash. It's a long-term inflation index bond. In simple terms, when you lock in your inflation index future coupon payments from your bond, you don't really care about the price of your bond in the interim, since a drop in prices is offset by an increase in expected return. You can use the coupon payments to buy your lunch even if the bond price falls by 20%. Now, what's interesting is that long-term inflation index bond prices can be extremely volatile, as we saw in 2022. So a short-term investor would probably call them risky. Cash does not change in price in response to changes in interest rates. Its nominal value is very stable day to day. This is great for a short-term investor since they want to be able to spend their cash today and tomorrow, but it leaves long-term investors exposed to the risk of falling expected returns. Expected returns matter a lot for long-term investors since they're relying on their assets to generate returns far into the future. If you need $50,000 per year for the next 30 years and you buy a 30-year bond, you're set, even if interest rates fall. But if you buy a 1-year bond at 5% and then interest rates fall to, say, 3%, you have a massive shortfall to fund for the next 29 years. If expected returns fall, long-term bonds hedge your ability to afford your lifestyle in the future, while cash offers no such protection. In this way, stocks are sort of like bonds. When their prices fall, their expected returns rise. This also means that, like bonds, stocks are less risky for a long-term investor than their short-term price fluctuations would otherwise suggest. When expected returns fall, long-term asset prices, like those of stocks and long-term bonds, will tend to rise, offsetting the effects of lower expected returns for long-term investors. Cash also has lower expected returns than stocks and bonds in most environments since cash does not command a risk premium. Stocks and bonds are expected to earn a premium above and beyond the return on cash to compensate investors for taking risk. Based on this, we should expect that when interest rates increase, expected returns on stocks and bonds also increase. And this is exactly what we see in the data. In a global sample of countries with continuous histories back to 1900, 5-year returns on stocks and bonds sorted on their starting real interest rates increase with higher starting interest rates. This suggests that, as theory would predict, the risk premiums for stocks and bonds above cash are persistent even at higher interest rates. This is important. Even if interest rates are high, expected returns are being left on the table when you hold cash. This consistently lower expected return on cash means that it will be much more challenging to meet your long-term financial goals. You'll need to expect to save more or spend less in the future to compensate. But the lower expected returns also increase the risk of losing purchasing power in the long run. Investors have historically been significantly more likely to lose purchasing power holding cash, measured by short-term government bills, than holding stocks or bonds in the long run. In a broad sample of 38 developed markets from 1890 to 2019, the bootstrap estimate of 30-year real loss probabilities for government bills is 37% compared to 27% for intermediate bonds, 13% for domestic stocks, and 4% for international stocks. Not only has the probability of loss been greater, but the magnitude has as well. Importantly, this is only true at longer horizons. At short horizons, as you would hope, cash has been safer than stocks and bonds. If you hear this and think that you'll hang tight sitting on cash until the market drops and then invest in stocks, I have a word of caution. When we've looked at the idea of buying the dip, sitting on cash until a market drop of 10 or 20% and then investing in stocks, we've found that buying the dip trails investing a lump sum most of the time and by a wide margin on average. This finding is consistent with stocks and bonds having higher expected returns than cash. Cash yields are currently high, potentially enticing long-term investors to hold cash rather than investing in stocks and bonds. The problem is that the expected return on cash is unpredictable, and cash does not offer a hedge against falling expected returns, which can be materially detrimental to long-term investors. Cash also has lower expected returns than stocks and bonds in all interest rate environments and is much more likely to lose purchasing power in the long run. Holding cash can feel really good, and even better at 5%. But long-term investors are likely better off in stocks and bonds in the long run. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you enjoyed this video, please share it with someone who has their long-term investments sitting in cash.